All right, if you trade SPX options, you've seen it. That weird, lopsided grin on the implied volatility curve, the volatility smirk. But is it just some market quirk, or is it actually a code that we can crack for a real trading edge? Well, today, we're going to dive deep and see if we can turn this anomaly into a seriously practical tool for your trading playbook.
Okay, so in a perfect textbook world, the famous Black-Scholes model tells us that implied volatility should just be a nice, flat line. Super simple, clean, totally predictable. But we don't trade in a textbook, do we? The real market is messy. It prices risk all over the place, and that creates this distinct pattern that tells a really fascinating story about fear and what the market expects to happen next. So here's our game plan. We're going to start with why that perfect model just doesn't hold up. Then we'll decode the smirk itself, figure out where it even came from, learn how to read it, and finally, the best part, get into some actual strategies for trading this fear gauge. All right, Section 1, a perfect model's flaw. Let's start with that core problem, right? I mean, why doesn't this Nobel Prize-winning model actually match what we see in the SPX market every single day?
So the whole thing is built on this really elegant mathematical idea that stock returns fit perfectly into a neat bell curve, a log normal distribution. And in that pristine world, huge out-of-nowhere price drops, they're supposed to be incredibly rare, like once-in-a-lifetime kind of events. But you and I both know that's just not how things actually work in the real world.
And this is exactly where reality and the model part ways. It leads us to this super important concept called fat tails. It's basically a fancy term for what we see happen all the time. Those extreme, crazy market moves happen way more often than the neat little model says they should. The tails of that bell curve are fatter because, well, the risk of a massive market swing is just always there.
And this has a huge impact on option pricing. Think about it. If those giant moves are more likely than the model thinks, then the options that pay off big during those moves, we're talking deep out-of-the-money puts, are going to be in higher demand. The market prices them higher than the formula says they should be. And that, right there, that's the fundamental crack in the whole Black-Scholes foundation.
Okay, part 2, decoding the volatility smirk. We know the model's flawed, so how does the market show us this? Well, it creates these patterns in the data, almost like a visual language for risk.
Okay, let's start with the basics, the classic volatility smile. Just picture a perfect symmetrical U shape. Here, implied volatility is at its lowest right at the money, and it rises equally on both sides for puts and calls. You see this a lot in Forex, for example, where a huge move up is seen as pretty much just as likely as a huge move down.
Now, technically, anytime that line isn't perfectly flat, we call it a volatility skew. It's really just the broad catch-all term for any of these patterns.
But for equities, especially the SPX, we don't get that nice, even smile. We get a smirk. And this is where it gets really interesting. The curve is totally asymmetrical. Implied volatility just skyrockets for out-of-the-money puts, but it stays pretty low and flat for out-of-the-money calls. And that's not a random shape, you guys. That is the market screaming at us that it is way, way more worried about a crash than it is about some huge, unexpected rally.
All right, Section 3. So, why? Why the specific baked-in fear of the downside? It's a great question, because believe it or not, this pattern wasn't always here. A single catastrophic event basically burned this fear right into the market's DNA.
Before October of 1987, things were different. IV curves were pretty flat. The market just didn't have this constant underlying terror of a collapse. And then, Black Monday happened. After that absolute catastrophe, everything changed. This collective, permanent fear, what some call crashophobia, was born, and the volatility smirk showed up, and it has literally never left.
So there are really two big drivers that keep this smirk around. The first is that crashophobia we were just talking about. Think about it. Huge institutions are constantly buying out-of-the-money puts to act as insurance for their massive portfolios. That nonstop demand keeps the price of those puts and their implied volatility permanently jacked up. The second reason is more structural. It's called the leverage effect. It's simple. As a stock price falls, its debt-to-equity ratio goes up. The company becomes inherently riskier and therefore more volatile. It's a perfect inverse relationship that really helps explain the shape of the smirk.
Okay, let's get into the practical stuff. How to read the smirk. We know what it is, we know why it's there, so how do we actually read it and turn this thing into a real-time sentiment gauge for our trading?
It really all comes down to the steepness of the curve. When you see a really steep smirk, that means anxiety is high. The market is paying up big time for that downside protection. On the flip side, when the Smirk starts to flatten out, it means that fear is fading. This could be a sign of rising complacency or maybe even growing bullishness.
So how do we actually put a number on this feeling? Well, traders use a metric called a risk reversal. It's actually a pretty simple calculation. You just take the implied volatility of an out-of-the-money put and subtract the IV of an out-of-the-money call at the same delta, say 25 delta. The more negative that number is, the steeper and more fearful the Smirk. It's just a really quick and dirty way to quantify the market's anxiety.
And you can't talk about market fear without talking about the VIX, right? You could think of the VIX as basically a single number summary of this entire phenomenon. It's a fear index because it measures that collective demand for SPX options, the same demand that's driven by the fear that creates the Smirk. So when the Smirk gets steeper, you can bet the VIX is going up too.
And now for the grand finale, trading the fear gauge. This is the payoff, right? If we can read the market's fear, then we can trade it. So let's look at a couple of actionable strategies for SPX traders.
Okay, the core idea here is really simple. The Smirk makes out-of-the-money puts expensive and it makes out-of-the-money calls relatively cheap. That's it. So our strategies are all going to be built around exploiting that imbalance. We're either going to sell that overpriced fear or we're going to buy that underpriced optimism.
First up, a classic, the bullish risk reversal. The name isn't just a metric, it's an actual trade. So let's say your view is bullish, or you just think the Smirk is way too steep, that fear is overpriced. You sell one of those expensive OTM puts to collect that nice fat premium. Then you use that premium to buy a relatively cheap OTM call. What you're left with is a synthetic long position, but you got it at a huge discount, or maybe even for credit. You are literally trading the shape of the Smirk.
Okay, but what if you're bearish? What if you agree with all that fear priced into the market? You can still use the Smirk to your advantage with a bear put spread. So you buy a higher strike put to get your bearish position, but then you sell a lower strike put against it. And because the Smirk makes all out-of-the-money puts expensive, the one you're selling still has a nice high IV. This helps dramatically reduce the overall cost of putting on your bearish trade.
But here's a crucial point. The Smirk isn't the only pattern out there. Sometimes things get so bad that it morphs into something different, something more sinister. And this quote, which describes the market right before the 2008 crash, really captures that shift. It's a change from simple fear to something else entirely.
And if you compare two major crises, you can really see this in action. During the 2020 COVID crash, it was classic crashophobia. The fear was off the charts, and the Smirk became incredibly steep. But in 2008, it was different. The market moved past fear and into what you could call bearish certainty. The Smirk actually inverted into a frown. Implied vol calls started to drop too. That's a huge signal. It means the market wasn't just scared of a crash anymore. It had lost all hope of a rally. It's a state of total resignation, and that can be a much more dangerous signal than just a steep smart.
So as you can see, the volatility Smirk is so much more than just a weird line on a chart. It's a real-time, forward-looking map of the market's collective psychology. It shows you exactly where the fear is, how intense it is, and it can even warn you when that fear is morphing into something else entirely. So the only real question left is, how are you going to use it?